Since 2015, HM Revenue and Customs has handed back more than £1.5 billion to British pensioners. Not benefits, not compensation, their own money, tax that should never have been taken in the first place. And here's the part that ought to make you sit up. HMRC only gave it back to the people who asked. There is a form. It takes about 10 minutes. It is free. And HMRC will not send it to you, will not write to tell you it exists, and will not remind you. In the most recent quarter alone, they repaid over £44 million, with the average claim running to more than £3,000. My name is Robert. If you have ever taken money out of a pension, a lump sum, a one-off withdrawal, anything at all, there is a genuine chance a large sum was taken from you that you are entitled to have back. And later, I'll show you the small trick recommended by one of the country's own pension technical directors that stops this happening to you in the first place. Now, let me explain what goes wrong, because once you see it, you'll understand why the amounts are so large. When you take taxable money out of a pension for the first time, your pension provider has to deduct tax before paying you. Fine. The problem is which tax code they're told to use. If HMRC hasn't yet issued a proper code for that pension, and on a first withdrawal it usually hasn't, the provider must apply what's called an emergency month 1 code. And a month 1 code makes one very particular assumption. It treats whatever you've just taken as though you're going to take that same amount every single month for the rest of the year. So say you take a one-off £10,000. The system doesn't see £10,000. It sees somebody on $120,000 a year, and it taxes you accordingly, pushing chunks of your money into the 40% band, and sometimes the 45% band, on the assumption of an income you are never going to have. The result is that far too much tax comes off straight away, at source. Let me put a real shape on it. Imagine a pensioner whose only other income is the state pension, taking a taxable withdrawal of £15,000. Their genuine tax bill on that, at the basic rate, is somewhere around £3,000. Under the month 1 emergency code, the deduction can be dramatically more than that, thousands more, because the system has assumed they'll take £15,000 every month. And I want to be fair to the pension companies here, because people ring them up furious. Your provider is not being difficult. They are legally required to apply the code HMRC gives them. They cannot use their judgment and apply a sensible one instead, no matter how nicely you ask. They simply aren't allowed to. So the fault isn't your pension company. It's a system that has known about this for over a decade and still hasn't fixed it. Quick one. Tell me in the comments whether you've taken any money from a private or workplace pension yet. Just yes or no. I'd like to see how many of you may be sitting on a refund without knowing. And do subscribe if this is useful. Plain English every week. I've also put the whole picture together, pensions, tax, the state pension benefits into one guide with the current figures, linked below if you'd ever like it in one place. Everything you need today is free right here. Let me give you the numbers because they tell you this isn't a rare glitch. Between October and December of 2025, HMRC processed 13,652 reclaimed forms and repaid over £46 million. In the following quarter, January to March 2026, another 13,900 forms and just over £44 million. Quarter after quarter after quarter for a decade, which is how the total has passed $1.5 billion. Now, one honest note on the averages, because you'll see the average pensioner is owed £3,000 quoted everywhere. That figure is the total repaid divided by the number of forms processed. And HMRC has never confirmed that every form is a different person. So treat it as an average per claim rather than a promise about what you'd personally get. Your refund depends entirely on your own income and how much was taken. But here's the far more important point, and it's the one nobody says loudly enough. Those figures only count the people who filled in a form. Everybody else is invisible. If you took money out, were overtaxed and never claimed, you do not appear in that $1.5 billion, which means the true amount overtaxed is considerably higher than the headline. As one industry figure put it, the published numbers are likely the tip of the iceberg. Now, in fairness, HMRC has made a change. From April 2025, they improved how tax codes are handled for people newly receiving private pension income. So more cases get corrected automatically. That's a genuine improvement, and it deserves saying, but it hasn't solved it. If you take a regular monthly income, the system will usually right itself within a few months. If you take a single one-off withdrawal, which is exactly what most people do when they need a lump sum for a car, a roof, or to help a grandchild, you are still very likely to be overtaxed, and you're still left to either claim it back yourself or wait, because that's the choice you actually have. Claim, and HMRC aims to repay within 30 days. Don't claim, and you wait for HMRC to reconcile your tax at the end of the tax year, which can leave your money sitting with the revenue for months. Same amount either way. The only difference is who has it and for how long. Right. There isn't one form, there are three, and picking the wrong one slows everything down. It sounds fiddly, but the choice actually comes down to two simple questions. Did you empty the pot, and are you still working? Form P55. This is the one most people need. Use it if you took part of your pension. There's still money left in the pot, and you're not expecting to take any more from it before the end of the tax year. That's the classic case. Someone takes a lump sum for a specific purpose and leaves the rest invested. It's also, by a distance, the most commonly processed of the three. Form P53Z. Use this if you took your whole pot, and you still have other taxable income coming in. A job, another pension, taxable benefits. Form P50Z. Use this if you took your whole pot and you have stopped working entirely with no other taxable income. So, part of the pot, P55. All of it, and you've still got income, P53Z. All of it, and you've stopped, P50Z. There's a fourth worth mentioning in passing, Form P53, which is for reclaiming tax on trivial commutation or small pot lump sums. So if your withdrawal was under the small pots rules, that's your one. Now, how to actually do it? All of these can be completed online through your personal tax account on gov.uk, which is the fastest route, or you can download and post them. HMRC aims to repay within 30 days of receiving a completed form. Some people report 4 to 8 weeks in practice, but 30 days is the target. You'll need your pension payment details, the amount and the tax deducted, which will be on the pay slip or statement your provider sent you, plus an estimate of your other income for the tax year. Have that in front of you, and it genuinely is a 10-minute job. Two things worth knowing. First, this is free. You do not need to pay anybody. And I'll say this plainly because it matters. There are firms that advertise heavily to do this for you and take a percentage of your refund. They are doing a task you can complete yourself in 10 minutes on a government website. If you find the forms daunting, ask a family member. Don't hand over a slice of your own money. Second, don't leave it too long. Tax repayment claims generally have a 4-year window, so if you took money out a few years ago and never claimed, it may well still be open to you. But it doesn't stay open forever. Now the part I promised, and this is for anyone who hasn't taken money out yet, or who's planning another withdrawal. There's a simple tactic that can stop this happening at all, and it comes from Andrew Tully, Technical Director at pension firm Canada Life, quoted by the BBC on exactly this problem. Instead of taking your big withdrawal first, take a small one first. Something like £100. Here's why it works. That first small payment gets hit with the emergency code, but the tax on £100 is trivial, so the damage is nothing. Crucially, that payment triggers HMRC to issue a proper tax code to your pension provider. Then, when you take your real withdrawal a few weeks later, the provider already has the correct code and deducts roughly the right tax from the start. You've absorbed the emergency code on £100 instead of on $20,000. Same destination, no refund needed, no waiting. Now, two honest caveats, because I never want to give you half a strategy. One, it needs time to work. The correct code has to reach your provider before the big withdrawal, and that isn't instant. So this is something to do a few weeks ahead, not the same afternoon. Two, and this one really matters, taking taxable income from a pension can trigger something called the money purchase annual allowance, which permanently cuts how much you can pay into a pension each year from £60,000 down to £10,000. It applies to the £100 withdrawal exactly as it applies to a large one. So if you're still working, or you might pay into a pension again, do not do this casually, because you'd be triggering a permanent restriction to solve a temporary problem. If that's you, get advice first. And there's one other route worth knowing about. If you have a P45 from the current tax year, giving it to your pension provider before your first payment can prevent the emergency code altogether. That's a clean fix if you've just stopped work and have the paperwork in hand. So here's what to actually do. If you've already taken money out of a pension, go and find the statement or pay slip your provider sent you. Look at how much tax was deducted. If it looks far heavier than you'd expect on your income, you very likely have a claim. Then work out which of the three forms fits. Part of the pot, P55, all of it with other income, P53Z, all of it, and stopped work, P50Z, and file it through your personal tax account. 10 minutes, free, 30-day target. If you're planning a withdrawal, consider the small payment tactic a few weeks beforehand, or hand over a current year P45 if you have one. But check the money purchase annual allowance point first, if there's any chance you'll pay into a pension again. And check your tax code, whether or not any of this applies. If you see the letters M1 or W1 after your code, or the code BR, that's a sign something isn't running on a cumulative basis. Now the trap on the other side, because I promised you the full picture, and this catches people out in the opposite direction. Emergency tax doesn't always mean you've overpaid. If you have a high income, the month one calculation can occasionally deduct less than you actually owe. And HMRC will come back for the difference later. So a big withdrawal alongside a substantial salary or other income isn't automatically a refund. It can be a bill. Don't assume. Check the actual numbers. And one final thing that trips people up. Your 25% tax-free lump sum shouldn't be taxed at all. Emergency tax applies to the taxable part of a withdrawal. So if you see tax deducted from money you understood to be your tax-free cash, ring your provider. Something has gone wrong and it needs correcting rather than reclaiming. Let me leave you with what this really is. £1.5 billion has gone back to people who filled in a form. Nobody was written to. Nobody was reminded. The money simply sat with HMRC until somebody asked for it, and everybody who didn't ask is still waiting or has quietly forgotten it ever happened. A former pensions minister called this system an absolute disgrace and said there's no good reason citizens should have to chase back tax they should never have paid. I think that's right. But being right doesn't get anyone their money back. Filling in the form does. So if you've taken money from a pension in the last few years and you've never claimed, go and look at what was deducted. It cost you 10 minutes to find out, and the figures suggest a great many people are owed a meaningful sum. And if you know someone who's just retired and about to take a lump sum, tell them about the small first withdrawal. That one piece of information could save them from ever being in this position. One last honest note. This is general information, not personal tax advice. Everyone's income is different, the amounts vary enormously, and Scottish taxpayers have different bands. So check your own position on gov.uk or with a qualified advisor. And never respond to anyone who contacts you out of the blue offering to reclaim tax on your behalf. HMRC refunds are free to claim yourself, and cold callers promising refunds are one of the most common frauds aimed at people our age. Look after yourself. Look after your family, and I'll see you in the next one.